Ladies and gentlemen, welcome to the English Daily Book Summary YouTube channel. In order to not stop learning, listen to an English book summary every day for free.
Peter L. Bernstein. Capital Ideas. The Improbable Origins of Modern Wall Street. Most professions are resistant to change, and that was certainly the case for Wall Street money managers in the 20th century. For the most part, they didn't want some brainy kid from a university telling them that the calculations and formulas in his doctorate paper proved there was a better way to do their job. Still, this is more or less what happened, but it didn't happen overnight. As you'll see in this blink, it was a gradual process that spanned decades, and that was eventually pushed past the point of no return with the dawn of the computer age. This is the story of how a handful of academics built upon each other's work to modernize Wall Street, taking it from chalkboards and ticker tape to complex formulas and computer programming. The illusion of predictability. Since the dawn of modern finance, there's been an alluring goal: figuring out how to predict the stock market. Both amateurs and professionals alike have always been drawn to the possibility. By the early 1900s, there was already an entire industry of analysts and forecasters, each striving to crack the code of market movements. At the same time, there's been a nagging question. If anyone could successfully predict the market, why would they share their secret? But this is more or less a moot point, because the truth is, the stock market is fundamentally unpredictable. In 1900, a young mathematician, Louis Bachelier, published work that explained how stock prices are shaped by random factors, making precise forecasting virtually impossible. His research introduced the mathematical study of market fluctuations, suggesting that price changes are as likely to rise as they are to fall. Bachelier observed that while short-term price movements are small, their range expands over time, though not in a simple, linear fashion. Instead, price fluctuations follow a pattern proportional to the square root of time, a principle that would later be confirmed by decades of market data. Despite the groundbreaking nature of his findings, Bachelier's work remained in obscurity until the 1950s, when economists like Paul Samuelson and Jimmy Savage rediscovered and championed his theories. Meanwhile, the field of market analysis grew thanks to thinkers like Charles Dow, co-founder of the Wall Street Journal. He introduced tools such as the Dow Jones Averages and Dow Theory to analyze long-term market trends. His successors, William Peter Hamilton and Robert Rhea, built on his ideas. Rhea correctly predicted key market moments in the 1930s, but at the same time, he acknowledged that forecasting was often an unreliable task. In the 1930s, Alfred Cowles took a more rigorous approach to market forecasting. He tested thousands of market predictions and found that professional forecasters often failed to outperform the market, while flipping coins proved just as reliable as any forecasting method. Despite these sobering results, the desire to predict the market's movements persisted. Research be damned. People would not cease to be fascinated with market predictions. The story took a dramatic turn in 1952 when Harry Markowitz, a young graduate student at the University of Chicago, revolutionized the field. His paper, Portfolio Selection, showed that while you couldn't predict the fate of individual assets, you could build a diversified portfolio that would increase your chances of success. His key insight was that diversification wasn't about owning more assets, but about owning the right mix to manage risk. Markowitz's theoretical and complex work went unnoticed for some time, but his ideas later earned him a Nobel Prize in Economic Sciences and formed the foundation for modern portfolio management. The efficient portfolio. In the 1960s, portfolio management was more art than science. Investment strategies were often tailored to individual needs, such as prioritizing income for widows or seeking growth for ambitious executives. But this approach, likened to interior decorating, lacked a solid theoretical basis, leaving investors without a reliable framework for decision-making. That all changed with James Tobin, a Yale economist who revolutionized portfolio theory and brought much-needed structure to the field. Tobin built on the work of Harry Markowitz, but he simplified the complex process of identifying what was known as the efficient frontier, a set of investment portfolios offering the best return for a given level of risk. His 1958 paper introduced the separation theorem, which streamlined how investors balance risk and reward. Tobin's brilliance was in showing that portfolio management could be divided into two decisions. First, how much overall risk an investor is willing to take, and second, which collection of risky assets maximizes returns. This approach made the theory applicable to a wide range of investors, from cautious amateurs to risk-seeking professionals. However, while Tobin's work advanced the theory, it left an intriguing question. Could you simply calculate the efficient frontier? Enter William Sharpe, a young protege of Markowitz, who found a way to streamline the process. Sharpe's breakthrough came with the single index model, which focused on a dominant factor, like the overall stock market, and could measure both the risk and return of a stock. This shortcut dramatically reduced computing time, making the model more accessible and practical for everyday use. Sharpe didn't stop there. In 1964, he introduced the Capital Asset Pricing Model, CAPM, which built on his single index model and argued that the entire stock market is the ultimate super-efficient portfolio. According to CAPM, it's impossible to beat the market without taking on unnecessary risk. This controversial idea reshaped investing, making diversification and understanding market risk essential to modern investment strategies. Sharpe's innovations bridged the gap between theory and practice, forever changing how we think about risk, reward, and portfolio management. Information versus noise. In the late 1940s, brokerage firms began modernizing their operations, replacing blackboards with electrically powered quote boards that displayed stock prices on glowing green trans-lux screens. Despite these technological upgrades, Wall Street remained steadfast in its traditional views on the market. Alfred Cowles's pioneering research from the 1930s, which showed that professional investors were no better than random chance at predicting stock prices, went largely ignored. Meanwhile, stock prices soared in the 1950s, surpassing pre-depression highs, but skepticism lingered. As the market continued to boom, the field of economics was undergoing a shift. Most economists of the time lacked advanced mathematical or statistical training, and tools like computers were still out of reach. It was precisely this knowledge gap that allowed statisticians like Holbrook Working and Maurice Kendall to shine. In the 1930s and 1950s, their research demonstrated that while price levels might trend, actual price changes were largely random. Working's test comparing commodity price graphs to random number sequences showed that traders couldn't tell the difference, and Kendall expanded on this by showing that stock and commodity price data behaved like random walks. Astrophysicist M.F.M. Osborne further built on these ideas in 1959, comparing stock price movements to Brownian motion, the term for the random motion of particles. He reinforced Bachelier's theory that stock prices followed patterns so random that prediction was impossible. Despite these academic insights, Wall Street remained largely unaffected. The bull market of the late 1950s was too alluring, and many investors still believed they could beat the odds, ignoring the warnings of academics. Into this chaos stepped economist Paul Samuelson. Building on Bachelier's work, Samuelson developed a theory of capital markets that clarified the unpredictability of stock prices. He refined Bachelier's theories with a theory of his own that showed how percentage changes, rather than absolute changes, provided a better explanation for price movements. Samuelson also tackled the long-standing question of a stock's true value. He proposed that the best estimate of a stock's intrinsic value is its current market price, reflecting real-time reactions from buyers and sellers. He emphasized the importance of information flow in moving markets and how a single news story could ripple through, causing price shifts. But this could also lead to what he called noise, useless or unimportant information that could get in the way of making a clear valuation. Still, Samuelson concluded that predicting market winners and losers was fundamentally random. His work laid the foundation for the rational expectations hypothesis, acknowledging that while markets may not always be perfectly rational, they're driven by the constant flow of information. thus creating opportunities for those who possess solid knowledge. What is true value? In the 1960s, another academic, Eugene Fama, expanded on Paul Samuelson's work by exploring why stock prices seem to move randomly. After earning his doctorate at the University of Chicago, he focused on analyzing decades of stock market data. He showed how reinvested dividends and tax considerations consistently boosted long-term returns. This set the stage for his groundbreaking ideas on market efficiency. Like working in Kendall, Fama argued that stock prices follow a random walk. But he went a step further and put forth the notion that markets are efficient. They quickly reflect all available information, but not perfectly rational. His research sparked wide debate, reinforcing the idea that stock price movements are unpredictable, shaped by a variety of equally unpredictable factors. Building on this, Fama developed a three-level model of market efficiency: weak, meaning past prices don't predict future ones; semi-strong, prices adjust quickly to public information; and strong, some may exploit private information. His findings showed that most professional investors struggled to beat the market consistently, which of course didn't make Wall Street investors happy. Fama also reinforced the idea that for most investors, seeking average returns is the most realistic strategy. Now, when it comes to accurately assessing a stock's value, this work really began in 1938, when John Burr Williams introduced the dividend discount model. Williams argued that a stock's worth is the sum of its future cash flows, like dividends, discounted back to the present. While predicting these future returns is challenging, his model emphasized that a stock's value is rooted in tangible, expected returns, not speculative guessing. In contrast, Benjamin Graham offered a grounded approach. Graham was a pioneer of value investing, famous for being the mentor of Warren Buffett. Graham was all about using hard data, like earnings statements and balance sheets, to assess a stock's intrinsic value. Leveraging this information meant you could identify undervalued stocks, often overlooked by the market, which you could reliably expect to rise in value over time. Both Graham and Williams emphasized patience, discipline, and the ability to act contrary to the crowd, strategies that are crucial for long-term investors. Meanwhile, in 1956, Franco Modigliani and Merton Miller made waves in corporate finance by introducing the theory, which suggested that a firm's market value is independent of its capital structure. They argued that the cost of capital remains the same, regardless of whether a company relies on debt or equity. Their theory, based on the principle of arbitrage, showed that markets quickly adjust any differences in value created by changes in debt or equity. In other words, the theory provided evidence of market efficiency, which we'll explore more in the next section. The rise of the models. Modigliani and Miller's core theory proposed that a company's value is ultimately determined by the market, driven by investors buying and selling shares. This led to the concept of an efficient market, where forces push it toward equilibrium, even though some unpredictability and noise remain. As time went on, more people built upon this idea. The mathematician Fisher Black's work showed that many investors can be noise traders, causing temporary fluctuations in the market. But in the long run, he argued, the market still aims for balance. Jack Traynor, influenced by the theory, emphasized that accounting data alone couldn't explain a company's true value. Traynor focused on risk and return, particularly understanding the expectations for risky assets. This laid the groundwork for the development of a risk premium, which is the extra return an investor expects to earn for taking on a higher risk compared to a risk-free investment. This led to a crucial idea. Stocks with higher risk, known as beta, would offer higher returns to attract investors, while lower-risk stocks would offer lower returns. Traynor, alongside Modigliani, also explored the complex math behind investment decision-making. Now, bear with us because this is where things can get super heady. A key piece of information came from a lemma, or mathematical theorem, that had been developed by the Japanese mathematician Kiyoshi Ito. Ito's lemma gave researchers a way of formulating how fluctuating security prices work in continuous time. This later became a game changer, especially as investing became more computational and model-based. Drawing on Ito's lemma, Traynor and Modigliani evolved the Capital Asset Pricing Model, CAPM, which aimed to predict expected returns by factoring in the risk-free rate, the market's return, and a stock's beta. Despite CAPM's elegance, it faced criticism. The model had a static, single time frame and so couldn't account for real-world complexities, like the effects of inflation, taxes, and economic growth. But the CAPM paved the way for the creation of the arbitrage pricing theory, which provided a broader approach to understanding stock price movements. One model to rule them all. This section tells the story of a quiet revolution in investing, led by three unlikely figures: a techie who spent weekends tinkering with computers, a jazz musician from Kentucky, and a cautious banker from Wells Fargo. Together, they challenged the conservative world of trust investment and ultimately transformed it. Their ideas, initially seen as heresy by the old guard, reshaped the industry, marking a pivotal moment in the world of finance. The revolution began, ironically enough, at Wells Fargo, one of the oldest banks in the U.S. The instigator was John McCown, who'd worked with an MIT expert to develop a model that could identify undervalued stocks. At a trade show, Wells Fargo's chairman, Ransom Cook, saw McCown's presentation and hired him to lead the bank into the future. McCown's first task was to challenge the traditional belief that a small portfolio of stocks was enough. He pushed for diversification, even with stocks the bank didn't favor. His ideas extended beyond portfolio management, leading to the influential report measuring the investment performance of pension funds. McCown faced opposition, especially from James Verton, who was head of Wells Fargo's financial analysis department. But when McCown partnered with William Faust, a skilled jazz musician who was also a friend of Jack Traynor, the big breakthrough arrived. Faust suggested creating an index fund to mirror the entire stock market, an idea that eventually took off and led to the hugely popular S&P 500 index fund. By the 1980s, their investment model was a $10 billion business. The success of the index fund marked a turning point in investment history. It showed that investors didn't need to actively pick stocks to achieve solid returns. Data demonstrated that investing in the entire market often outperformed attempts to beat it. This victory for quantitative, data-driven investing soon became undeniable, even for the staunchest critics. Insurance for a better future. The last development is one of the more controversial innovations, but perhaps the most important as well. It's the creation of portfolio insurance, an innovative idea sparked by finance professor Hayne Leland. In 1976, during a conversation with his brother John, Leland began to wonder whether investors could have the same kind of disaster insurance other areas of ownership provided. Was it possible for investors to protect their portfolios from market downturns? Leland's breakthrough was based on the put option, which allows investors to sell stocks at a predetermined price to protect against market losses. His innovation was scaling this idea to entire portfolios, not just individual stocks. Since options were typically used for single stocks, Leland had to get creative. He combined cash and stocks in a way that mimicked the protective qualities of a put option, eventually creating the concept of portfolio insurance. Leland, along with Mark Rubenstein, refined the strategy, and by 1978 they realized they had developed something with real potential. The challenge, however, was predicting market volatility, a crucial factor for the strategy's success. Despite these hurdles, Leland and Rubenstein's firm, Leland Rubenstein Associates, gained traction in developing the strategy. But the true test came in 1987 when the stock market crashed. During the 1987 crash, the assumptions behind portfolio insurance, such as continuous markets and available liquidity, were shattered. The strategy couldn't protect against sudden, massive market declines, causing it to lose favor in the US. But the idea continued to attract interest abroad, especially in Japan, where it was applied more cautiously. Although portfolio insurance failed during the 1987 crash, it laid the groundwork for future innovations in risk management. The strategy's rise and fall spurred the development of more sophisticated tools for balancing risk and return. This chapter also emphasized the stock market's fundamental role in the economy, acting as a crucial mechanism for valuing corporations, providing liquidity, and facilitating investment. without which the economy would falter. These innovations all reinforced the idea of an efficient market and likely made it even more efficient in the process. But challenges persist. The market has seen reduced liquidity, meaning it's become more difficult to sell an asset without reducing its value or easily converting an asset to cash. Along with the rise of new financial instruments, these are serious concerns that require both ongoing innovation and regulation. Today, the market is more important than ever, and it's up to us to ensure it remains efficient and effective. In this blink to Capital Ideas by Peter L. Bernstein, you've learned that Wall Street was forever changed by a small group of academic economists. Driven by a mathematical approach to the stock market, they transformed the way we understand risk, reward, and market behavior. Their key insight, that there is no reward without risk, and that outsmarting competitors in a free market is incredibly difficult, led to the development of groundbreaking financial tools such as options, futures, and portfolio management strategies. These innovations not only made Wall Street more efficient, but also created more opportunities for both individual and institutional investors. Through this transformation, Wall Street became a more accessible and dynamic marketplace, fundamentally changing the way people manage capital and take on investment risk. Okay, that's it for this blink. We hope you enjoyed it. If you can, please take the time to leave us a rating. We always appreciate your feedback. See you soon.